Welcome back, everyone, to a brand new episode of the Crypto and Muay Thai podcast. I'm your host, Chris Brookins. Today, I'm extremely happy to be able to introduce Marcel Berger. He's the founder of Berger Crypto. And for those of you who follow his work on crypto Twitter, he is one of the forefront individual in terms of crafting a more refined analytical approach to this particular space, in particular whenever analyzing Bitcoin, so aptly dubbed econometrics, a mashup between Bitcoin and econometrics for those who, kind of had the good grace to learn a little bit about econometrics. Marcel, it's a pleasure to have you on the podcast. How are you doing today?
Yeah, thank you very much for the invite, Chris. I'm very happy to be on your show and looking forward to record a nice episode.
Excellent. We're super happy to have you on here as well. So with that, for those of you who might be listening that don't necessarily know your background, why don't you just give the listeners maybe a quick 2-minute overview of your background and how you found your way into this wild world of crypto?
Yeah, sure. Let me start 12 years ago. That was the time I graduated from uni, where I followed a program on econometrics. My direction was in quant finance and actuarial sciences. For those who are unaware of what actuarial sciences is, it's basically the math behind the insurance world. And I started my career as a market maker with Optiver, where I traded derivatives, especially focused on equity derivatives. Did that for roughly 2 years, then became a consultant with EY, moved to London, worked with Morgan Stanley at the time to analyze and value more complex interest rate derivatives. Came back to the Netherlands in 2012 and pursued my career as a portfolio manager with Acmea Investment Management, where I was responsible for managing balance sheets for institutional funds, mainly pension funds. And over there, the focus was on managing interest rate exposures. And I was mainly responsible for all the quant development and also, of course, for maintaining portfolios of derivatives. I think it was start of the end of 2016, where I started to get interested in this entire new asset class that was on the rise. My interest at the time was sparked by reading about Ethereum, because as a quant, I was always looking at how to automate things and to make things more efficient. And the idea of programmable money that could find its own flow, well, that was quite appealing to me. So I decided I wanted to learn more, and I jumped into every course on Coursera I was able to find with respect to cryptography and cryptocurrencies 101, I guess, where all the ins and outs about Bitcoin were explained as well. And it took me, I guess, something like 4 or 5 months before I decided that the best way to actually get a better understanding of everything would be to get your hands dirty. So that was when I started to build a portfolio myself and started to move those assets around. And that was partly driven by some great stories from my college friends from uni, who did pretty damn well with Bitcoin. So the interest was sparked from two directions. One from a technical point of view, and to make the world a better and more automated and more efficient place. And the other one was just the financial side of things. You don't find assets that do so extremely well very often. So that really sparked my interest as well.
Yeah, for sure. I think Bitcoin is one of those things where even blockchain technology in and of itself is one of those topics that captures people's imagination, it speaks to each and every single thing that maybe they're interested in or had existing experience in terms of work. So I was talking about that on last podcast with Tyrone Ross, is that no matter where you're at, it can speak to you if you're a cryptographer, or if you're a finance individual, or maybe if you're a software engineer. It just speaks to everyone, which is why I think the space is so incredibly inclusive. But also, I think that's why whenever people first get exposed to it, it's just days and days and days of just sort of falling down the rabbit hole, learning about this and learning about that. So I totally agree with that narrative and had a very much similar experience myself. So with that, you're starting to get your hands dirty a little bit.
Yeah, exactly.
What are some of the things that you're starting to see as you get your hands dirty trading in this space?
Well, one of the first things I noticed, because I basically came around at the time that Ethereum lifted off, and I was analyzing the entire space with a couple of friends from uni. And I myself had a really strong financial background as a portfolio manager and trader and risk manager. And the guys who I actually run the entire analysis with were coming from completely different directions. So one had a legal background and the other one had a strong mathematical background with a focus on cryptography. So he was quite familiar with the entire scene already. I like to refer to it as scene still, because it still feels a bit of a different, it's a bit of an underground movement. But and I don't think it is an underground movement anymore these days, but well, at the start of 2017, it certainly was. But the funny thing was, he was really into the space already, and he knew all the ins and outs, but he wasn't invested. And so it was at that time that we, well, the three of us decided to actually get exposure and do it properly. So one of the things we very soon found out was that all the altcoins that were listed on several exchanges, that they were much more volatile than Bitcoin was, and that the best way to get involved in that game would be to join in the ICOs, because what we noticed at the time was that the best return on investment was to be made if you were involved in the initial coin offering at the time. At least if you knew how to pick the right projects, because there were many projects that also returned close to zero or even much worse. But yeah, we did quite well in that respect, so I think we neared roughly, it was near the end of 2017 that I decided that I wanted to do a bit more than only being involved from an individual point of view. So I was looking if it was possible with my previous employer to set up a fund or to do something in a more institutional kind of way. But at that time, the business wasn't ready yet, and the infrastructure wasn't even there yet as well. So everything was still being built, and there was not a lot of interest at the time, not even to set up things in a sort of sandbox kind of environment. So I decided that my ways had to separate with my previous employer, and I decided to start founding my own company. That was, I think I went live in January 2018. Yeah, it was January 2018 that I went live with, at the time called Burger Crypto Consultancy. And I was at that time only helping people with their crypto portfolio management, basically. And that was interesting, but as soon as at time moved on, there were lots of those kind of private paid groups run by cowboys, and I decided that it wouldn't be the best way to go forward. In a combination with the decline of interest because of the bear market that started around February 2018, I decided to change plans and was lucky to find some people who were looking to outsource their asset management. So I decided to switch towards serving high net worth individuals, and that's basically the cornerstone of Burger Crypto today. I'm serving or I'm helping high net worth individuals with their crypto asset management. And let's see, I mean, that was my business until I think it was early 2019, and at the time I started to also think about more like the investment consultancy kind of services as well, because I come from that area myself, so I've seen a lot of different services that can be offered. But yeah, I mean, it always is, of course, a matter of finding your own right way in this arena. And I think it was the end of 2018 already that crypto derivatives really started to catch on some fire. These days it's really how my of derivatives from running asset management services. This could be actually my my niche, so to say. That's why I launched this year a sort of dynamic hedging services, so customized dynamic hedging services, where I basically help people to get to protect their downside risk by means of sophisticated option strategies for Bitcoin and Ether. So yeah, I think that's in a nutshell where I am today. One of the things I've noticed myself is that you just keep an ear out and see what people are or look what people are actually looking for, and how the world around you is changing, and see how you can combine the two into product offerings that will actually help people forward.
Yeah, I completely agree. I think from my experience as well, I think one of the things that this asset class is lacking at the current moment is a little bit more sophistication around being able to hedge out or manage some of the risk, given how cyclical the market is. There's very wild swings on the upside, but also on the downside as well. And, whereas traditional markets, those cycles might follow, or at least on paper, look a little bit more linear, a little bit smoother, longer rolling. In crypto, you can have something, 2020 being a great example, where January to the end of February, you had a raging bull market. And then March to mid-April, you had a very strong bear market. And then since then, you've had a very strong bull market. And now we're kind of like ranging where it's just essentially playing back and forth between 10,000 and 9,000. So you figure that it's only the first half of the year is just completed, and there's been 4 entirely different regimes within this market data structure. So I think it's incredibly opportunistic for individuals like ourselves to be able to offer more sophisticated services to try to help hedge out some of those risks as well. But also, it's opportunistic for profit making as well, just given sort of everything that's there. If you can manage that well, your downside, make sure you're protecting capital. You can also ride some of those waves on the upside as well. So
Yep.
I totally agree with everything you just said. Where does your analysis, so for any listeners that don't know Marcel's work, he came on the scene because a fellow Dutch investor, an anonymous individual named Plan B, who has tons of followers on Twitter and has built up a really strong fan base, so to speak, but is essentially created a model, a linear model, likening Bitcoin to gold. And he did that through stock to flow, essentially meaning a scarcity driven model. So the total amount, the issuance, the total supply divided by the new issuance of Bitcoin in this particular case, which is programmatic versus gold, having to mine it and find it throughout the world. And that model has essentially been the cornerstone where a lot of Bitcoin bulls have been saying, you know, we're going well above 10,000, going to 50,000, 100,000, and so on and so forth, based upon his sort of linear projections. And then you burst on the scene, analyzing that stock to flow model at the beginning, originally taking more of a critical standpoint, but then actually diving into it through a more advanced statistical technique called co-integration. You actually validated it. Fast forward, we'll talk about, some of the corrections you made to that, but walk us through how you first got exposure to the stock to flow model and what made you want to kind of analyze that and come on the scene with it, presumably as a way to get your name out there and build a little bit of business and brand recognition, for Burger Crypto.
Yeah. Yeah. So because I'm running a asset management service, I'm always looking for fundamental models or quantitative models that are really helpful in supporting your investment decisions. Because I'm on the lookout, I also came across the stock to flow model when it just got out, and I was quite surprised with what I saw when I first looked at it. I was like, "Whoa, this looks quite promising." Then I had a deeper dive, and one of my first realizations was that Plan B was looking at price instead of returns, and as an econometrist, that's quite rare, because whenever we look at the markets, we usually do that by in terms of returns, and usually in terms like daily returns or monthly returns, but actually never in terms of prices. So I was a bit puzzled about it when I first read it, and I discussed it with a couple of friends from uni at the time, and they were like, think back of your classes and just check the model against like all the basic assumptions that are required, that you're required to meet when you actually apply linear regression. So I first reached out to Plan B, just sharing my conclusions, and it was just by means of a tweet. Hey, listen, I read your paper, and I think you might be looking at a spurious relation here, but that was before I actually did any analysis myself. So at the time he asked if I would be able to meet, so we actually met each other and we had lunch together. And then after I decided to actually take the model for a spin and do a proper model review on it. So that was behind my first article at the time. And it was also the first time I actually did a full-blown econometric review on a model that was launched by another person in the scene, because there are so many different models around there, and this was actually the first time I decided I wanted to go for a model validation, so to say. And that was probably also due to the fact that this was a kind of model that I felt comfortable with. I mean, as I already mentioned in the introduction, I have an econometric background, so regression analysis is a really big part of that studies. So yeah, for me that was something familiar, but it was also like 12 years ago already at the time. So I actually had to get my books from the shelves and look back into the material sometimes. So that was basically how it started. I shared my findings at the time when I finished the analysis. At first I wasn't really happy with it, because a couple of or I'm not sure how many of them actually were violated, but some of the basic assumptions behind a linear regression model were violated or were not met. So I said, well, okay, listen, the model isn't sound enough for me, so I would urge everyone to be cautious taking investment decisions based upon this model. And that's where I left it. So I went on a holiday, and when I was celebrating my holidays, Nick, the guy from Australia, he came out with his first analysis as well. He flagged that if we would test for co-integration, that there was actually that we weren't able to reject it. And that would mean that stock to flow and Bitcoin market cap would be or would have a long-term relation to each other. So I was a bit flabbergasted at the time, and I really needed to redo my work again. And I decided to run the entire analysis on myself as well, because I was all the time working with my own data set. I think Plan B was always looking into monthly data, and I was running the entire analysis with daily data. And there were some like minor differences between my data set and the data sets that Nick and Plan B were both using. But that doesn't really matter. But the point was that when I first found out, I wasn't really even sure that Nick was a independent person. I first thought that, well, it could actually be Plan B himself under a different name, or it can be like a sort of sock puppet account. You never know in the crypto scene. So I said, well, if I want to be sure, I really need to do a proper analysis myself. And I decided to run 3 different co-integration tests, and they all turned out to be positive. So that was quite a great moment to recall, because I immediately reached out to my friends that I used to run all the analysis with together. Said, well, hey guys, look at my findings here. I can only support the model now, and this is quite. This is actually something big here, because if we would be able to forecast the price of Bitcoin by looking at the stock to flow metric, then we actually have a complete way or route into the future, or routing into the future, and it would we would be sort of able to predict where Bitcoin is actually going. And of course, you can never talk about predictions, but you always talk about forecasting, because we don't have crystal balls over here.
Like a range of values, and I remember I remember whenever that your Medium post came online, sort of validating, talking about, hey, my original goal was to, show the flaws within this particular model. I myself have an analytical background more than most. And that was one of the first things that I saw whenever I was looking at the stock to flow model initially at a high level. It's like, okay, we know that historically, or in general, asset prices are stochastic, nonlinear, but he's trying to fit a linear model to what can only be viewed as nonlinear data. And then you take into consideration, he wasn't looking at returns. I don't believe he was looking at log of returns as well. I could be
No,
incorrect.
log price only.
Okay, log price only. So I knew there was a lot of flaws within it, but then whenever I saw your piece come out, and you walk the reader through, which is a great article, through your analysis and how you took it step by step, I was like, okay, this is from an individual that actually knows analytics. Not to say that Plan B doesn't, but you took more of a sophisticated, rigorous approach. And then co-integration, I myself had not had experience working with co-integration, or even thinking about looking for it at that particular time. But whenever I saw it, I used your notebook that you had put out, that you had publicly or publicly published on GitHub. And I was like, all right, just like you, let me use my own independent data. Let me use daily data that I found from an independent resource. I typically tend to use BlockTap, which is another data analytics company or data provider within Pittsburgh, my hometown. And then just ran all the analysis that you talked about and got to the same exact conclusion that you did. There were some differences, but still within the general band that we were talking about, that it was highly significant in terms of all three co-integration tests. And given that, knowing that Bitcoin's issuance and its supply is fixed, it's predictable, that was potentially a game changer whenever you look at it from a forecasting perspective, to where you think, all right, you can't predict the future because just intuitively, we know there's some element of demand affecting price. But if majority or 50 or even 60% of price is derived from the stock to flow model, that is incredibly powerful because it is knowable. We know what the issuance rate is going to be when it's cut, and we know what the ultimate supply is going to be as well. So I was along for the ride, just like you, saying, okay, I thought originally that this was nonsense, that there was a lot of violations, but then validating co-integration myself with my own two eyes and independent data, then I was like, okay, now we need to start taking things into consideration, still with the caveat knowing that I've been in the markets before pretty much my entire career, knowing that there's always going to be some layer of demand. And I put out a few pieces talking about, elasticity of active addresses and things like that, to show that demand does have a factor in price. But again, like I said, if there's something there with stock to flow, that can be incredibly powerful for forecasting future prices. So you did that. Now we're fast forwarding maybe a handful of months, maybe even a year. I don't know how long. There was an individual that reached out to you, I believe from a university, and said, hey, you need to reassess your co-integration model because there's some violations in it, because there's a deterministic factor within the stock to flow.
Yeah, the funny thing was, I think both Nick and I, we actually defended the co-integration part of the story quite heavily in the period from, I think it was August 19 to December 19, and maybe even after, but especially the early 2020, I was a bit tired of having to defend it all the time, and I was like, okay, what? Piss off! I'm so sick of having to defend it every time, and especially to people who are clueless about the entire statistical approach. So one of the most heard points of critique at the time was, how can we have such a simple model actually explain price, and it's just nonsense. And well, to me, if the data shows you that it is possible, then for me it's okay. I mean, like I always say, all models are wrong, but some tend to be useful. And it's not my quote, of course, but it's from George Box. But I like to refer to it always. It was also the #1 lesson that we got at uni when we first started to build our first models, actually. But anyway, so yeah, I think in that time I also debunked the time model. It was quite a popular model at the time as well, which was only relating the evolution of price over time. or versus time actually. And I think it was actually with the Value of Bitcoin conference in May 2020, where a professor in econometrics was invited to speak on the stock-to-flow model as well, and he showed that that the model was really flawed, and that was because he corrected for deterministic elements in the stock-to-flow time series. But when he corrected for those deterministic elements, I actually didn't know why he was correcting for those elements. I mean, if you're going to correct your time series for specific elements, then of course your results will change as well. But at the time, and he wasn't really able to explain to me as well why he was actually making those corrections. Because he gave a presentation on the matter during the Value of Bitcoin conference, and in the after chat on Telegram, I reached out to him and I was like, okay, but I noticed that you corrected for those deterministic elements, but why are you doing that? Because I didn't really get a satisfying answer at the time, I decided to dig into the theory again. So I dove into the articles from Engel and Granger on co-integration, and looking for definitions on integration order and co-integration itself. And then it was there. Basically, for the definition of integration order, it stated that you can only determine the order of integration after correcting for deterministic elements. Well, and that's quite painful for the stock-to-flow metric on itself, because and that was one of the things I did in my article as well. If you look at the stock-to-flow time series, and instead of looking at time, you chart it first as block height, then the entire time series becomes completely deterministic, because you know that every 210,000 blocks there's a jump, of course, because you have a halving there, and in between those halvings, you have a steady mining reward every 10 or every block, basically. And the only stochastic elements in the stock-to-flow time series arise from the fact that there is a varying inter-arrival time for each block. So ideally, every block would come every 10 minutes, but that isn't the case in practice. So that's basically what's causing the stock-to-flow metric to be stochastic in that sense. But still, if you look at the stock-to-flow time series, then you can still recognize the deterministic trend and the deterministic jumps. You can easily identify them or recognize them by the naked eye. And if you correct those stock-to-flow time series for those deterministic elements, then the one thing that remains is a zeroth order integrated time series, which is basically a stationary time series. And there is no such thing as co-integration between a stationary and a non-stationary time series. So per definition, co-integration was off the table. And with co-integration being off the table, there was no longer supporting evidence for the relation between stock-to-flow and Bitcoin price to be non-spurious. So that was of course a very important finding, I would say, but it was also a very unpopular finding as well, because it was more or less a bump under the model, so to say. And something I notice is that even when you bring this reality to the world, there are so many people who don't like to hear it. They just rather live in their own dream world than accepting the fact that there is new evidence that shows that the model is not as good as we thought it was. So
that was one of the things that I saw on your Twitter feed. You're like, yep, it's confirmed. I've lost a bunch of followers because of
yeah,
essentially reporting on the truth. And the crypto space is really, really interesting because we're all figuring it out kind of as, we're building the car as we're driving it. But
exactly.
there's this faction of diehard individuals, and they only want to hear popular news, and that Bitcoin in the space is going, Bitcoin's going to 100,000 or a million per Bitcoin, and the space is going to grow up and be worth trillions of dollars in market cap. And then there's the pragmatists who are searching for truth, realizing like, hey, this is a really new nascent market, but it's awesome because we get to discover and write history right now together. And it gives opportunities for individuals like ourselves that are searching for truth. And whenever you discover something that holds up statistically, that's pretty freaking exciting. But at the same exact time, you've got to have a very honest view with yourself to go back and look at some of your previous work and say, that no longer holds because I missed out on this. And I think this whole experience of you essentially starting to disprove, show some of the flaws within the model, and then stumbling upon co-integration, and then being essentially one of its largest champions in combination with Plan B to disproving it. I think it's one of those elements to where people need to make sure that they're constantly doing their own homework, because even people that have high quantitative IQ, there's mistakes that can be had because there's so many different things that you've got to look at. You mentioned it at the beginning. You had to start going back and digging through your academic literature books to actually really figure out what this was and make sure that you're doing it appropriately. And I myself, I hadn't run into co-integration before, but then I had to go and through some of my academic books and then look at it and say, okay. And then again, whenever we have to correct for some of those deterministics, and I've had to do that for tons of different quantitative techniques or new metrics that I was looking to create as well. So I think that's an incredibly powerful kind of exercise for the space, but obviously, for yourself as well. With that being said, where do you see Bitcoin going now in a post stock to flow world, now knowing that, again, what we kind of knew at the beginning intuitively is that this model appears to be backfitted, meaning you're taking historical data and then creating a model that you look to be super great, but whenever you actually forecast it out into the future, it's not going to be very accurate at all. Only time will tell, but statistically, that seems to be the case of what's going on. So where do you see Bitcoin going in this post-stock to flow world? And do you even think that Bitcoin needs sort of this omnipotent model to validate individuals' involvement within the Bitcoin space? So I think people use it almost as a demigod, as to validation for institutions as to why they should be getting exposure to the space, because it's saying, hey, you need to get in now at 10,000 or 9,000 because it's going to 50,000, it's going to 100,000. So do you even think that we need that in this particular space?
Yeah, the funny thing is, in the start of 2018, just after Bitcoin reached its previous all-time high, or actually its last all-time high, a couple of Dutch institutional asset managers reached out because they like to discuss the materials with me, and they were triggered by the fact that the market capitalization of Bitcoin actually exceeded some of the asset classes they were already invested in. And their reasoning at the time was, if we are already invested in those asset classes that have a smaller market cap, then we actually need to consider Bitcoin or crypto in general as well. And one of, well, there were, I think at the time there were mainly two factors that held them back. One was a lack of fundamental valuation models. The other one was the extreme volatility. So my focus has been on looking into valuation models and investment supportive or models to actually support your investment decisions, whatever they may be. And I think there has been a lot of attention for models that are built around the on-chain metrics, like the models deployed by Willy Woo and by David Puel. And my how do you say that? I've been actually looking into developing something similar myself as well. Looking into the existing models and see if there were any interesting findings to be found there. But yeah, it's really a very tough challenge, I would say. To answer your question, I really do think that proper valuation models will definitely help the space forward in terms of institutional adoption. And in that regard, I think Plan B is still on a good track by trying to bring us S2FX model more alive by incorporating more assets. And whether or not the model is completely sound from an academical point of view or from an econometric point of view, it doesn't actually matter that much, I guess, because if there are plenty of people reading about this work and walking away with it, even in the institutional space, then it will get traction. You could argue that it might get traction then for the wrong reasons. But yeah, traction is traction. So
yeah, I think that's one of the interesting things about this space as well. I guess traditional finance in and of itself is it doesn't necessarily need to be correct. It's just got to tell a compelling narrative, and it's got to tell it in a way that a lot of traditional allocators understand. So I think that's why Bloomberg's pieces, Mike McGloin over at Bloomberg has a really big following because he frames things in ways that traditional allocators understand. So looking at active addresses, again, is proxy for demand, and then a whole bunch of other stuff that you would look at more traditionally. So I think you're right with that. And stock to flow, regardless for all its shortcomings, definitely kind of fits that mold, given it's not overly complex. So it's a least squares model. It's a linear model where a lot of traditional allocators understand it and understand the framework, and maybe can even make their particular corrections for some of the assumptions that they might necessarily look at and be like, oh, that, we can correct for that. We don't think there's necessarily a good fit or whatever it may be. So I think you're totally right on that particular perspective. And with that, do you see the space moving in? So I see it in two different directions. So Plan B and even yourself, you've kind of taken a more, what would just dub an analytical approach towards valuation, essentially using mathematics to project a potential future value, and then even potentially discount it back to the present if anyone gets a model, a valuation model that they think is semi-reliable. And then there's the valuation approach, almost as if we were looking at a traditional company and forecasting cash flows out and then discounting back to, based upon some underlying fundamental metrics and projected growth for that as well. So whether that's active addresses, hash rate, or whatever it may be, which do you think is going to be most palatable for institutions looking to enter this space? Or do you think there's room for both, either on the quant side or more of what you would kind of look at as corporate finance style valuation?
Yeah, yeah. Whenever I think about corporate finance style valuation, I always think in terms of like relative value and multiples, and I think that's very helpful in getting a feeling of relative value between other projects compared to Bitcoin, or relative value, for instance, in the DeFi world, for instance. But in terms of like, what would really help Bitcoin forward in terms of like institutional adoption, I think, it needs to be something that that holds, right? It needs to be something that is that makes sense, and in that sense, for me, stock to flow was a very compelling story, in terms of, because you can easily compare it to, for instance, gold and silver, and see how they hold up and what their market caps are. So in that sense, the stock to flow model, and which is a sort of relative value approach, in my understanding, or in my opinion, and I think in the long run, there's certainly room for both approaches, both like the forecasting approaches, as in like relative value models. But yeah, it all depends on the quality of the models, and I mean, it's of course very easy to hype a certain model among retail investors who lack a certain quantitative background. But if you want to convince the institutional quants, that's a very different ballgame, because they do understand what you're saying, and they do really understand in depth the models and the methodologies that you're trying to apply. So if you really want to win that game, then you need to step up and make sure that you bring your A game in terms of financial modeling as well.
Seems like a bit of a mix, it's like, okay, maybe there'll be some space for corporate finance, but there would have to be something compelling. And I think the individuals that might be at the forefront, again, you mentioned Willy Woo and David Peel, but also the guys over at Coinmetrics, they've got a lot of data, and sometimes how they curate it, I really think they do a compelling way. I guess the guys at Masari do a pretty good job of that as well. So I think if anyone's going to be able to create some kind of like fundamental valuation model that's more in line with what maybe investors would think of as a price to earnings ratio, or a cash to book value, or anything like that, to where they can think about it from a conceptual level of forecasting out a future value based upon some independent variable input, whether that's active addresses, transaction value, blah, 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 and then discount it back to the present with some commensurate discount rate. I think if there can be some reliability of that will ultimately float to the top. And then from a quantitative perspective, I totally agree. I don't think we're there in the space with that right now. And I think one of the reasons why is just the lack of data, the limitation of data. So like you were talking about with retailers, but which is kind of endemic of this space, people will put things out, and I guess I've been guilty of that too, is they'll find something, essentially data mining, with their existing confirmation bias, and find something that supports their confirmation bias with a sample size of like 3 or 4, and then say, well, historically it's done this, and it's like, okay, it's done this in the past, but that's a sample size of 4, and they sort of put it out as gospel, and then the crypto sphere will grab a hold of it and say that it's this, it's validated and all these things. I think that's incredibly dangerous, especially for a lot of new retail individuals that are looking to get involved in the space. So personally, I would like to see that go away and be replaced by something that is more rigorous, which is why, again, it was painful to see co-integration fail, because that was a rigorous statistical, test that we did. to prove that there is a relationship here, not necessarily correlation, because that can kind of come and go and be unstable, but saying that it stays within this particular band. It cannot stray too far from one another over the life of the assets.
Yeah.
So I don't know what'll be the next step for that. Obviously, Plan B recently has kind of taken a little bit of a pivot towards the S&P 500 and Bitcoin price, looking to validate co-integration there. So I spoke to him and I validated co-integration. I believe it was at a 90% confidence interval looking at the Engel Granger. So good, but not necessarily like overwhelming. I'm sorry, I did that with the Johansson test. The Engel Granger actually came out at a 99. So it was highly significant. But again, I don't necessarily know. I think in theory it makes sense given the past 10 years, both markets have kind of been in a bull market, so to speak. So in theory it makes sense. But again, I think there might be a lack of data there that kind of makes conclusions from that spurious, given it's just happenstance that, you know, Bitcoin was created at the downturn of the last great financial crisis. And then since then, the Feds pumped tons of money into the space. The S&P has been on arguably its best bull run in its history. And then Bitcoin has benefited from that in a variety of ways, given it's been good times economically, good times with excess cash and equities for people to want to invest, and also historically low interest rates as well. So although I validated it to a certain degree, I think there still might be a little bit of, you know, confirmation bias or lack of small sample size. I don't believe you had a chance to look at that, but with some of the work that you're, you know, pushing forward in your, you know, next book, Biconometrics, do you think there's a space for some of that analytics, or are you looking in an entirely different sphere to develop?
No, for sure. No, because I think those things are very valuable to show in the book as well. And basically, the idea behind the book was twofold. One was to make statistical modeling and analysis around it more open for a larger audience. Because if you take any book on statistical modeling off the shelves, well, you're running into very technical explanations of the material. And what I noticed in all the Twitter discussions was that people, on average, they have a very hard time to grasp, to get a hang of it, actually. So that was one of the ideas behind it. And the other one was to show some nice examples and to help people to actually to help them to build out those models themselves, or to run these kind of analysis themselves, by just giving them some easy to follow instructions on how to set up a analysis, or how to build a model by using Python, for instance, and all the different Python packages that you would need. So the book should cover two things. One is a very easy to follow layout of the theory around it, and the other one is a very easy to follow instructional step by step scheme to do it yourself, basically. I think adding these kind of examples is really useful, and because people, for one, they like these kind of analysis, and the other thing is that even if you find results that don't support your thesis, then it's very valuable as well, because you actually show people that certain theses aren't right, or I think it will definitely it could definitely have a place in the book as well.
Okay. Yeah, I totally agree with that. I think that makes sense, especially in this new early space of where we're at, being able to show kind of like the process of going through the different models, the iterations, the false starts, and then eventually getting to something that is simple enough to be informative. But as I always say, and you kind of mentioned before, there's no such thing as a silver bullet. So you're not going to look at a model and it's going to be a crystal ball of the world. And being able to explain that in a simple way, but also at the same exact time, um, being able to show that process as to why it can be trusted as an additional input into how you look at and view this space, whether that is from a high net worth individual's perspective, looking maybe to shave off a little bit of volatility in the space, or from an institutional perspective as well, looking to get exposure or maybe increase exposure to their existing asset classes as well. So with that, where do you see the space moving towards in the future? Do you think the volatility will be here for an extended period of time? Or do you think ultimately, as more and more stable capital flows from institutions come in, maybe some of that volatility will gradually diminish a little bit? And then with that, how do you foresee that affecting strategies like yours, being able to use derivatives to take off some of the volatility as well, essentially hedge some of that downside ball?
Yeah, actually, it's a good question, and it's something I used to think about a lot. And um, when in 2018 we saw derivatives getting their introduction into the space, I really expected that we would also see a very large reduction in volatility. And well, for a moment, I actually thought that we were witnessing it as well, until COVID kicked in, and that's of course a once in a lifetime event, I think. But the impact on the markets, and especially on Bitcoin at the time, was incredible. And I might even argue that derivatives actually um, caused a larger than larger than normal. I was about to say, but what would be normal? I think it fueled the correction at the time, because what I understood is that all the liquidations on BitMEX basically drove down Bitcoin, and if BitMEX wouldn't wouldn't have been turned out, or the engines wouldn't have been turned out at the time, then price could have collapsed even further. So yeah, at first my expectation would be that the derivatives actually would help to suppress volatility over the long term, and that the entrance of institutional capital would also be sort of a positive effect.
So what you said right there is the importance of derivatives being used for management of risk versus speculation. So I put out a piece as well talking about that, around the time that Bitcoin crashed, essentially saying that you saw this huge surge in open interest in futures on BitMEX, and then all that got unwound literally within almost like a 24-hour period, that just kind of cascaded down and dropped Bitcoin price as well. So it seems like what you're talking about is the need to transition, at least in some framing capacity. I don't think you're ever going to be able to take all the speculation out of any financial market, let alone crypto assets. But more and more introduction of derivatives in terms of risk management versus speculation, looking to double, triple, quadruple your money in the course of what, a week, 7 days,
Yep.
10 days. So yeah, I totally agree with you on that. Whenever you're looking at sort of managing some of those hedge risks. Do your clients come to you and say, hey, I think it's getting a little frothy? Or do you, again, kind of lean on maybe some of the econometric models that you put together or are putting together for Bitcoin to say, historically, this has kind of been when things start to get a little frothy, or historically, this has been a fairly good time for accumulation. So I guess, again, going back to trying to get some useful guidance, not a silver bullet, but being able to like work within the hash mark, so to speak. So using an American football reference.
I'm not so familiar with with the American football world, so but I can of course shed some light on how I help my clients. Basically, the entire idea about the offering stems from my experience in the institutional world, where I helped pension funds to hedge their balance sheet risk by using dynamic hedging approaches. So the funny thing is, or the interesting thing is that there is no silver bullet strategy, basically. So what's a good strategy for you is not necessarily a good strategy for me. And what in my experience so far is that people have different beliefs on where Bitcoin might rally, but also where they start feeling some pain, some financial pain. And if you want to help people to avoid pain, then you can start building a strategy around it. But that strategy should be completely customized to their own specific set of investment beliefs, but also to their specific set of risk preferences. So yeah, that's basically how I help them as well. So the first thing that we walk through is like risk preferences and investment beliefs, and then we can start crafting a complete hedging strategy around it. So yeah, that's one. And second thing that I noticed was that as soon as I started to help people with these kind of questions, people also noticed that I was actually capable of helping people with all sorts of derivatives questions. And one of the very interesting questions that came on, or that landed on my plate, was a couple of days before the big collapse, where a person with a very large option position basically asked me to help him to analyze his his entire position, because the position was grown so incredibly large that he didn't really have a clue about where the risks were and how to manage those risks. So yeah, that's a very nice evolution, basically, of my services as well. As soon as I start to launch a certain service or a sort of product, people start to notice that you're actually skilled in a certain area, and they start to reach out to you with different questions that are related to what you're offering, actually. So that also leads to a sort of evolution of your own product offering as well. But that's on the side.
Gotcha. So it seems like it's more a la carte, like specific to each individual client that you have, which makes sense given the space is sort of, it's not nascent anymore, but it's very new. And I think people are still figuring it out from the perspective of the different offerings and services that are there, which kind of rhyme with what's on traditional exchanges, but it's a little bit different based upon the asset class is different, and the amount of leverage that can happen, and also expiry for some of the contracts are a little bit different as well. So I can totally see how that would grow and expand throughout the life cycle.
And it's a very especially the derivatives market is a very young market, but it's growing rapidly at the moment. especially if you look I'm not sure if you're familiar with skew.com, but it's a great website to actually follow all the metrics for the derivatives, the different derivatives platforms. And if you look at the growth of the space, it's astonishing. So for me, that's music to my ears, because I already have like 12 years of experience with derivatives. So to be able to actually add some value to this space in that regard is very is something I would love to do, of course. So far I think my clients also are really enjoying my services on that perspective, or in that regard as well.
Yeah, I'm familiar with Skew. I think it's a great website. In all honesty, it provides tons of information. We don't play too much. I don't personally play too much within derivatives for my investment fund, but being able to look at that, given how quickly the space is growing, it can definitely offer some indicators into which way the market is shaping up. So our particular way that we view the market is kind of how I talked about at the beginning, looking for inflection points, just given how cyclical this market is, and kind of position yourself best as possible for those inflection points. So one of the indicators that we use, it's called Hurst Exponent. You may or may not have heard of it. Yeah, it's been around for tons of years, but how we kind of calibrate it for Bitcoin data and then a couple of other assets that we track as well is to help spot local inflection points. And we simply do that by monitoring momentum. So whenever momentum gets to a point where you look at the market, it's trending so much. Historically, again, that has been a good time for a reversal, whether that's going to be a bearish inflection point on the top side, so being above 0.65, which is kind of like our gauge, and then for a bullish inflection point beneath 0.35. The scale's 0 to 1 for anyone that doesn't know. And then kind of look through there to say, like, all right, maybe we need to take a little risk off, or in your case, hedge a little bit on the top side, because maybe it's getting a little bit frothy, or maybe it's time to get a little aggressive, whether we're looking for a call strategy or anything like that through there. So I think we view the market through very similar lens. We just use different mechanisms to kind of articulate that. So with that, I think we've covered a wide array of topics, which hopefully I'll throw some links in for any individuals that might want to dive a little bit deeper into that as well. But if there's anything else that you want to say, maybe about yourself or where you think the future of Bitcoin is going. I know a lot of people listen to this and say, oh, he's a naysayer because we've talked about, disvalidating co-integration. Feel free to do that, sort of right now. But if not, we'll just kind of wrap up and look forward to talking with you again on the next edition.
Sure. I think that one of the last things might be nice to mention is that I'm looking to throw a webinar on managing risk of your portfolio in terms of like managing the risk of your spot, future, and options in one go. And I've launched or publicly shared a self-developed tool quite recently, which I like to refer to as the crypto red. So it's the crypto risk assessment tool. It's nothing more than just a simple Google spreadsheet with a connection to some of the APIs of the Deribit platform. But what it does, it really gives you a lot of insight in all the different Greeks and with it into all the risks that you run while running a portfolio, which includes derivatives as well. So I'm actually thinking about what I said. I'm thinking about throwing a webinar to run people through all the specific details that you run into when you start trading options and other derivatives, but also how to use this specific tool to step up your game, basically. So that might be a good one to emphasize. Further on, I would say thank you very much for the very pleasant conversation. and it's good to have some people in the space who are approaching all the new models with the same mindset, being critical and wanting to validate the model themselves. So hopefully we can see some more contributions from you in the years to come as well. And I would be very happy to have another conversation maybe in a couple of months again or something.
Yeah, that sounds great. We'll definitely have another conversation in a couple of months. Hopefully there'll be some developments on both of our sides. But yeah, the conversation was great. Being able to talk about things from a different perspective. But I think you and I both are cut from the same exact cloth, where we want to get to the truth, and maybe we use different tools, different techniques, but ultimately that's the goal that we're looking to do, not only for ourselves, but also the clients that we serve as well. So for those that are listening, I'll make sure that I include a link to the Crypto Rat that Marcel was talking about. And then also, if this podcast comes out within the span whenever he gets the link up and running for the informational webinar, I'll make sure that I include that as well whenever we release the podcast. So with that wraps up another episode of the Crypto and Muay Thai podcast. Thank you so much for listening. And again, Marcel, thank you so much for joining us. I can't wait to talk to you next time.